Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Grab Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath. And today we have a really fascinating setup to look into.
We really do. I mean, Grab is essentially the lifeblood of Southeast Asia,
Right.
You use it to commute to work, you order your dinner with it, you use it to pay your electric bill.
Yeah.
It is just woven into the daily fabric of millions of lives over there.
Yeah, it's huge. But if you look at how Wall Street has treated the stock lately, it's been absolutely battered.
Oh,
It's
yeah.
down over 22% year to date.
But quietly, beneath that surface level bleeding, there is this massive contrarian story unfolding. Insiders are suddenly backing up the truck to buy millions of shares.
Yeah, which creates this massive immediate tension for you as an investor, right? When a dominant regional powerhouse drops 22% in half a year, you have to ask yourself, is this a falling knife? Like, is it just going to keep dropping because the business model is fundamentally broken? Or are we looking at a major turnaround opportunity at multi-year lows and the market has just, aggressively overreacted to short-term noise?
Exactly. And before we get into the mechanics of the stock and really answer that exact question, having the right visual tools it's crucial for spotting these exact kinds of setups.
Oh, for sure.
So if you want help reading trading charts more clearly, you can check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite, and it shows you visual buy and sell chart alerts.
Yeah, and it has trend direction tools, right?
Yeah, trend direction, support and resistance zones, and take profit and stop loss planning areas. And it works across markets like stocks, forex, crypto, gold, futures, all of that.
Just remember, though, VIP Algos is an educational chart analysis tool only. It is not financial advice.
Right. It does not place trades for you, and it absolutely does not guarantee profits. Trading involves risk, so always manage your risk and do your own research. And just so you're aware, that is an affiliate link in the description, so we may earn a commission if you use it at no extra cost to you.
All right, so to understand why insiders might be buying this dip, we first have to understand the wealth building context here.
Okay, let's get into it.
For long-term positioning, Grab fits perfectly into a turnaround and high growth profile, specifically for investors looking for exposure to emerging market tech, because they are the absolute dominant super app across Southeast Asia.
And I think we really need to pause here and define what a super app actually means in practice.
Yeah, that's a good point.
Because in Western markets, we don't really have a true equivalent. To put it in perspective for you, it's basically like taking Uber, DoorDash, and a digital bank like Cash App and just baking them all into a single unified platform on your phone.
It's everything in one place. Right. From a consumer convenience standpoint, it's incredible. But from a skeptical, analytical perspective, having your hands in that many massive operational heavy industries, doesn't that require just a staggering amount of capital to sustain?
Oh, absolutely.
Because historically, ride-hailing and food delivery are just cash-burning machines.
They traditionally are, yeah. And that was the original knock against the company for years. But here is the mechanism that changes the math. Because they've bundled all these daily services together, they've created massive switching costs for both consumers and merchants.
Okay, walk us through how that actually works on the ground, like practically.
Well, think about it like trying to untangle yourself from Apple's ecosystem.
Oh, yeah. Good luck with that.
Right. It is very easy to delete a standalone food delivery app if a competitor offers you a $2 discount. But if deleting that food delivery app also means you lose your primary digital wallet, your loyalty points, and like the only reliable way you get a ride at the train station every morning, you're trapped.
Wow, yeah. You stay in the ecosystem.
Exactly. And what that does over the long term is build a massive competitive moat. And more importantly, it drastically lowers their customer acquisition costs.
Because they aren't paying to acquire the same user twice.
Precisely. They don't have to spend a fortune marketing a new fintech product to a user because that user is already opening the app twice a day for rides and food anyway.
That cross-pollination of the user base makes a lot of sense. It's an ecosystem trap, but in the best possible way for a business.
Yeah, exactly.
But, an ecosystem is only valuable if it actually translates to the bottom line. So they have this sticky super app, But are they actually making money?
Yes. And this is the most exciting fundamental shift happening right now. They have officially crossed the inflection point into profitability.
Okay, I have to stop you there because for years, the narrative around these gig economy tech companies was that they would never actually turn a real profit.
Right, without endlessly subsidizing users.
Exactly. So how exactly did they pull this off?
They did it by fundamentally changing their operating behavior. During their high growth phase, they were throwing money at driver incentives and consumer discounts just to aggressively capture market share.
The classic growth at all costs playbook.
Yep. But now they've turned off the tap. They stopped the heavy subsidies, they streamlined their capital structure, and they aggressively reduced their corporate cash burn. And the beautiful thing is, the users stayed.
So the switching costs actually held up.
They held up perfectly. Revenue is up 21.8% year over year.
Oh, wow.
Yeah. And they're now sitting on a highly impressive 43.54% gross margin.
That is solid.
It really is.
Yeah.
And they've reached a 10.7% net margin. They are officially posting positive earnings per share of $0.0884.
Okay, so you're praising this operational discipline and crossing into profitability as a milestone, absolutely.
Definitely.
But we have to look at what we are actually paying for this milestone today. Grab currently has a market cap of $16.1 billion. They are trading at a price-to-earnings ratio of roughly 42 and a price-to-sales ratio of 4.5. I mean, a PE of 42 means the market is already pricing in a virtually flawless victory over the next decade.
It's pricing in a lot of optimism.
Yeah. So for a company operating in the volatility of emerging markets, aren't we paying way too high a premium for this growth? Especially considering they aren't paying any dividends to reward shareholders for taking on that geopolitical risk.
It's a very valid concern. I mean, paying a 42 multiple is never cheap. But that premium valuation is the market looking forward, pricing in the trajectory of that 10.7% net margin expanding even further.
So you're betting on the margin growth, not just the current earnings.
Exactly. And you're right, they aren't paying dividends. But for a high-growth tech companies, that is entirely by design.
Because they need the capital.
Yes. When a company is crossing into profitability and growing revenue at almost 22%, you do not want them handing that cash back to you in a taxable dividend.
Right, that makes sense.
You want them aggressively reinvesting that capital to capture more market share, specifically in their financial services segment. Fintech and digital banking are incredibly scalable.
Well, it's a reinvestment loop.
Exactly. Taking ride-hailing profits and using it to fund digital banking dominance. That is what justifies the growth premium here.
Okay, so they're finally printing money, but because of that premium valuation, they are on a very short leash with Wall Street.
Very short.
They have to constantly prove they deserve that multiple. So what is the actual event on the horizon that forces the market to wake up and validate this turnaround?
The immediate focal point is going to be their Q2 2025 earnings coming up in August. The entire market is going to be laser-focused on one specific metric, and that's EBITDA margins.
And for anyone who gets lost in the financial jargon, EBITDA is essentially earnings before interest, taxes, depreciation, and amortization.
Right, exactly.
It's basically a way to look at the pure core operational cash flow of the business by stripping out all the accounting noise.
Yes. Wall Street wants to see if those core operational margins are continuing to expand despite some severe regional regulatory challenges, which we will get to in a moment.
Yeah, we definitely need to talk about Indonesia.
We do. But if management can step up in August and prove that the profitability inflection wasn't just a one-off lucky quarter, that establishes a trend. And establishing a trend of profitable growth is a massive catalyst for a re-rating of the stock.
There are also some really interesting macro tailwinds to consider here, too.
Oh, for sure. Like what?
Well, we could be looking at a broader sector rotation back into profitable emerging market tech as interest rates stabilize. But beyond just capital flows, I want to bring up a somewhat unique comparison.
Okay, let's hear it.
Think about the massive, catastrophic global tech outages we've seen recently. Like, think about the Telstra disruption that essentially brought things to a halt because of outdated legacy infrastructure.
Oh, right. That was a mess.
Exactly. When you see national grids or telecommunications fail like that, it really highlights the immense, almost foundational value of modernized, highly robust platforms like Grab's ecosystem.
That is a fantastic point, because when an entire region relies on a super app for transport, for food logistics and for banking, the underlying technology infrastructure has to be flawless.
It becomes indispensable.
Yeah, the reliability of the platform becomes a utility in and of itself, much like water or electricity.
But here is the disconnect. The business relies on flawless tech, but if we look at the chart right now, the price action is anything but flawless.
Right. So let's pivot to the technicals. Looking at the current landscape, the stock is trading around $3.93.
Okay.
For context, that is roughly 40% away from its 52-week high of $6.62, which it hit back in September of 2025.
So a pretty steep drop.
Very steep. And it recently scraped a 52-week low of $3.18 on June 11th, 2026.
You know, I'm looking at this price structure, and there is something that stands out immediately. A major multi-year support level that dates all the way back to the Q3 2022 bottom was recently breached.
Yeah, it broke through.
And if you are holding the stock and you watch it break a multi-year support level, your stomach drops. I mean, your instinct is to sell immediately because it looks like a falling knife.
It does.
It's the kind of technical breakdown that usually triggers algorithmic selling and sheer panic.
Ordinarily, yes.
Right.
Breaking a multi-year floor is terrifying.
Yeah.
But this is why you have to look under the hood at the volume footprint. Because here is the silver lining.
Okay, what do we see?
When that support level broke, the volume didn't spike. In fact, volume is currently sitting at a very normal 0.97 times the daily average.
So no panic.
There is no panic selling happening.
Explain why that lack of volume is actually a bullish signal for a contrarian, though.
Because it tells us the sellers are completely exhausted. Everyone who wanted to panic sell because of the year-to-date drop has already left the building.
Right. They're already gone.
Exactly. When a key level breaks and the volume stays flat, it means the algorithmic cascade didn't happen. Instead, if you look at the 13-week return, it's actually positive. It's up 9.60%.
Really? That's interesting.
Yeah. This suggests we're seeing what's called a basing pattern. The bleeding has stopped, and contrarian fundamental buyers are quietly stepping in, absorbing whatever light selling is left, and basically building a new floor under the price.
So the chart gives us a picture of quiet accumulation, but what does the actual market sentiment look like behind closed doors? Like, are the people running the company actually buying this turnaround story themselves?
The sentiment data gives us the most staggering data point of this entire analysis, actually.
Oh.
And it comes down to insider buying.
Oh, this is the good stuff.
Yeah. Over the last 90 days, insiders at the company have net purchased over 11 million shares.
Wait, 11 million shares?
7 million. We are talking about 30 individual buy transactions versus only 32 sells.
Okay, 11 million shares is a massive number. But as an analytical investor, I have to be highly skeptical here. Executives at tech companies get stock options all the time at higher discounted rates.
That's true.
Are these actual open market purchases with their own cash, or is this just routine scheduled vesting that makes it look like they are buying?
It is a mix, but a significant portion of this represents genuine cluster buying from management at multi-year lows. And that is a massive, undeniable vote of confidence.
Because they see the internal numbers.
Think about the psychology, right? They have the real-time data. They see the daily active users. They see the underlying financials. They see the margin expansion happening in real time, and they are choosing to increase their exposure heavily.
That's compelling.
And it's not just the insiders looking at this favorably. The analyst outlook is shifting too. Seeking Alpha recently upgraded them to a strong buy. Barclays is maintaining an overweight rating, and they put a $5 price target on it.
Which implies roughly a 27% upside from current levels.
Exactly.
Okay, you're painting a really rosy picture here with the insider buying and the margin expansion, but we have to get back to reality. Analysts get it wrong all the time.
Of course they do.
If the fundamentals are so incredibly strong and the ecosystem is this inescapable moat, why is the stock actually down 22% this year? Like, what is the market pricing in that could completely break this bullish thesis?
You are absolutely right to demand the bear case, because that sentiment picture is useless if we ignore the risks.
Right.
The stock has been punished recently, and it mostly comes down to one massive, severe regulatory shock.
Right, the situation in Indonesia. This is the biggest glaring red flag on the table.
It really is.
Indonesia just implemented a regulatory change that slashes ride-hailing take rates from 20% all the way down to a capped 8%.
It's brutal.
And to put the gravity of that in perspective for you, Indonesia is Grab's largest single market. Having your take rate, literally the cut you keep from every single ride, slashed by more than half overnight by a government decree, is a brutal gut punch.
Yeah, that kind of severe revenue compression is exactly what terrifies Wall Street, because it can severely impact their forward earnings per share. It
Exactly.
is a massive blow. There's no way to sugarcoat it. A 60% haircut on top-line revenue for every ride in your biggest territory is a thesis-altering event.
So how are they addressing it?
Well, management's stance is that the continued hypergrowth in their food delivery segment and their high-margin fintech products will offset this regulatory hit to the ride-hailing side.
But that introduces unbelievable execution risk. I mean, they basically have to perfectly execute double-digit growth in digital banking and food logistics just to fill the massive revenue hole left by the Indonesian regulators.
Yes, exactly.
If they stumble in fintech even a little bit, the whole profitability narrative just collapses.
It forces them to fire on all cylinders everywhere else just to tread water in Indonesia. And that regulatory risk is compounded by a secondary risk: strategic decoupling.
Ah, right.
Dara Khosrowshahi, the CEO of Uber, has officially stepped down from Grab's board of directors.
Which is a really fascinating development. Losing a high-profile strategic link to a global ride-hailing leader like Uber is highly concerning.
It definitely raises some eyebrows.
Because Uber has seen all the pitfalls of this industry globally. Losing that brain trust could signal a reduction in technology sharing. Or, on a more pessimistic note, it could signal rising competition if Uber decides to alter its posture and re-engage more aggressively in the Southeast Asian region.
That board departure definitely removes a layer of strategic insulation they used to have. It leaves Grab a bit more isolated on the global stage.
Yeah, vulnerable.
And on top of these company-specific issues, you just cannot ignore the broader macro risks. We are seeing elevated market volatility driven by geopolitical tensions.
Like the conflicts involving the U.S. and Iran.
Exactly. When geopolitical fear spikes, global tech multiples generally get pressured. You get what's called multiple compression.
Explain how that impacts Grab specifically.
Well, it means even if Grab's underlying earnings are fantastic, investors get scared. They pull their money out of emerging markets entirely, and the PE ratio shrinks simply because the whole neighborhood is deemed too risky.
So we have a company that has finally achieved the holy grail of profitability and massive insider buying, but they are staring down the barrel of a 60% take rate cut in their biggest market, plus the loss of a key global partner.
That's the setup.
With everything on the table, what is the final verdict?
Based on the fundamental margin expansion weighing against those severe regulatory headwinds, the final verdict is a bullish score of 7 out of 10.
Walk us through what a 7 out of 10 actually means for someone looking at the stock today.
It means this is a speculative, bullish, asymmetric upside play.
Asymmetric meaning what exactly?
Meaning the potential upside if they actually pull off the fintech expansion far outweighs the downside risk at these current suppressed price levels.
Got it. And what's the timeline?
The target horizon here is absolutely a multi-year hold, roughly 12 to 18 months, targeting a reversion to the $5 to $5.50 range. The core thesis is that over the next year and a half, the Indonesian regulatory impacts will be fully absorbed and overshadowed by the ecosystem's aggressive growth in the digital banking sectors.
But it requires patience, and it requires watching that EBITDA margin in August like a hawk.
Absolutely.
Now, mandatory disclaimer for everyone listening. This is an educational discussion. It is not financial advice. You must do your own research, understand your own time horizons, and manage your own risk carefully.
Always do your own research.
Exactly. Now, as how we wrap up today's analysis, I want to leave you with a final, slightly provocative thought to ponder regarding that strategic decoupling we just talked about.
Okay.
With the Uber CEO stepping off the board, the immediate market reaction is to view it as a negative isolation.
Right, like they lost a big brother.
But could this actually force their hand in a positive, transformative way? Like, could this sudden separation force Grab to seek out a massive new regional partnership, perhaps with a major EV manufacturer or a local semiconductor giant, to completely fortify its independence as we enter the coming era of autonomous driving?
Oh, that's an interesting angle.
Right, because sometimes losing a legacy partner is exactly the catalyst a company needs to build the infrastructure of the future.
I like that perspective a lot. It's definitely something to watch.
Definitely. And if you want a cleaner, more visual way to read trading charts as you research these kinds of asymmetric setups on your own, check out VIP Algos through the link below in the description.
Yep, it's a great tool.
VIP Algos is a TradingView indicator suite equipped with visual buy and sell alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas.
It really can help make complex charts much easier to scan.
But remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading inherently involves risk, so always do your own research and manage your risk carefully. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this analysis helped you understand the mechanics of this market a little better, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.